first thing is knowing what kind of entity you are. Now, a lot of folks, they'll submit to get a LLC started at least. They'll file with their state and say, hey, I want to be a limited liability company. That tax status is the same as the first scenario, which is you just starting, basically a sole proprietor or partnership.
Welcome to the Painter Growth Podcast, where we help you scale your painting company in record time. Join us as we explore sales, marketing, hiring, finances, leadership, and more, everything that you need to know to scale and grow your painting business. I hope you enjoy and subscribe. What's up, everybody? Mike Hickman here, founder of paintergrowth.com. You're listening to the Painter Growth Podcast. Happy New Year, or it started January. This might be, right towards the end of January when this gets released. And hopefully it's very timely for you because we're getting to that point where we got to pay Uncle Sam. we got to belly up to the tax man and see what we owe. And I brought on my friend Daniel, founder and CEO of Bookkeeping For Painters, to help us make sure that we know what's coming and how to potentially reduce our tax liabilities. So, hey, Daniel, good to have you again.
Thanks, Mike. Appreciate you giving me the invitation and opportunity.
Yeah. Well, I mean, when it comes to helping people, first of all, understanding what your tax burden is, and then finding ways to, reduce that amount of tax you have to pay, then, you're kind of the go-to guy in the industry. So happy that you could make it on here. Now, I remember back in the day, my first year painting, I finished my year, thought it was great, had a lot of money coming in the account. But then when it came to pay the tax man, I think it was like $25,000 that I didn't have anymore. Right. Yeah, I'm sure a lot of people had that. So what can people do to proactively, I know it's the start of the year, but going through the year, what can people proactively do to be more aware of the tax amount that they're going to be paying?
Sure. So great question. You do want to stay. Most folks think that taxes are something that just happened to them. They don't realize that they can actually impact what they have to pay in taxes in a lot of cases, especially if you're a business owner. One, get a proactive mindset with taxes because you can actually affect it. So the first thing I would say is know what type of entity you are. In the US, most folks, if you just start your painting business with no kind of filing with the state or anything like that, you're going to be a sole proprietor, or if you have a partner, you're a partnership. So that tax status, it's great. It's simple, to start out with. If you start making any kind of money, and just to put a number to it, in the US, if you're making more than $40,000 or $50,000 in net income, you might want to start considering to switch to a different tax entity because you start getting hit with a lot of self-employment taxes, is what it's called. So that's the first thing, is knowing what kind of entity you are. Now, a lot of folks, they'll submit to get a LLC started at least. They'll file with their state and say, hey, I want to be a limited liability company. That tax status is the same as the first scenario, which is you just starting, basically a sole proprietor or partnership. That is the same. You're getting taxed the same way, unless you do some sort of election with the IRS and say, hey, I want my LLC to be taxed as an S corporation. So know what kind of entity you have and how it is taxed.
So why is entity structure, at least in the States, I'm in Canada, so I can speak a little bit to the Canadian structure, but why is tax entity structure so important when it comes to calculating how much taxes you have to pay?
Yeah, great question. So the reason why it's important is because the way that your tax liability is calculated, whether it's going when it goes to your tax return, it tells basically the IRS how to tax it. So if you're a sole proprietor, partnership, or LLC taxed as a sole proprietor or partnership, every dollar that you're making of net profit gets taxed at the self-employment tax rate of 15.3%. And then on top of that, you're taxed at your tax bracket, whichever tax bracket you fall into, whether that's 22% or 15%, whatever it is. So you're kind of getting two hits twice with taxes: the self-employment tax at 15.3%, and then the tax bracket tax. Now, there's a way to get around that to avoid so much self-employment tax is to elect S corp tax status. So if you have an LLC set up, you can send a form 2553 into the IRS and say, hey, I want my LLC taxed as an S corp, from January 1 and forward. You can even, if right now, if you're listening to this and it's January, February 2024, and you're realizing, oh, I should have been taxed as an S corp last year, but I didn't do the election. You still could do a late filing. There's a way to do a late election on your form 2553 and actually get it back all the way back to 2023 January 1. So it's not all is lost if you haven't done it. The typical deadline is 2.5 months after the beginning of the year, but you can do a late election. So when you tell the IRS, hey, I want my LLC taxed as an S corporation, basically what you can do there is avoid a lot of self-employment taxes by taking a salary from the S corporation, your LLC taxed as an S corporation, let's say, a reasonable salary, let's say $40,000 or $50,000. You're paid.
Do you need to be employed as a W-2 within your own company, or can you
like you're paying your folks?
I mean, imagine most people, you would probably know best, but I imagine most people kind of just pay themselves with dividends, right? Like, oh, it was a pretty good month. I'm going to pull out, $8K or whatever.
Right. Yeah. They're just, distributions. They're just taking money, writing a check from the business to themselves, and just that's what they get paid. So, but you could still do that, but you'll have to also run payroll, reasonable payroll amount for yourself. For most folks, that ends up being somewhere between $40,000 and $50,000, $60,000. In some cases, lower or higher. It kind of depends on the situation. But so you run that W-2 employee payroll through the year and pay yourself that reasonable salary to meet the IRS requirement for S corps. You have to pay a reasonable salary, and the reason why they make that requirement is because all the other money that you're making. So let's say you did $100,000 in net profit. You take a reasonable salary of $40,000. The other $60,000 doesn't get self-employment taxes applied to it. So that $60,000 times that 15.3%. I'm doing math here real quick. About $9,000 in taxes saved. Mm-hmm. So it can be a good chunk of money. I just had a call the other day with somebody in this exact situation. They had $100,000 in net profit from 2023, and he's taxed as a sole proprietor. I think he had an LLC started, but he didn't realize that it's just basically taxed as a sole proprietor. And I was like, you can save almost $10,000 in taxes by getting a late election for 2023 and getting taxed as an S corp. Since it's the end of the year, you didn't obviously run a reasonable salary. There's a workaround for that where you can do a 1099 to yourself to basically pay those self-employment taxes. And so you won't get in trouble by not running a reasonable salary, because that is kind of a hot topic with the IRS, that you got to run that reasonable salary for your S corp. So bottom line, there's a workaround you can do if you didn't file, if you're filing late, or if you didn't run payroll for the previous year.
So let me ask like a clear question. I don't want to get too much in the weeds in specific situations. So if a painting, I would imagine most people listening to this are in the States, they have an LLC, right? Is that a reasonable assumption?
Yes, absolutely.
Which format is more tax advantageous to the guy who's, say, doing around 500K and wants to get to $1 million? Should they be a C corp or an S corp?
In most cases, it's going to be an S corp. Almost all cases. The only time you'd really want a C corp is if you want to get outside investors, a lot of foreign investors, like some craziness that or you have some sort of retirement account that you want to fund your business with. There's a certain special program, but in like 99% of the cases, S corp election. Yeah.
What are some ways that a painting contractor going throughout their year of business can do some tax forecasting and kind of understand how much they're going to have to pay, and just preemptively either put away or pay the IRS ahead of time to get some of that tax burden out of the way?
Mm-hmm. Yes. So I'll basically look at your tax return from the previous year. There's a line called your taxes, the taxes owed, how much you paid in taxes. Whoever did your tax return will probably provide tax vouchers, which are like estimated tax payments, and that tells you how much you should pay throughout the year. Um, and and it's based off of kind of like last year, how you did last year. And so, because usually, in a lot of cases, you're making about the same amount of money that you made in the previous year. Not always for business owners, especially. You kind of might go up and down, but last year's might be a decent kind of understanding of what you're going to have to pay this coming year. So looking at your tax return from the previous year, seeing how much you paid in taxes. There's a line on the form 1040 that says, taxes paid. That amount you could pay in estimated taxes throughout this year, and that's might be, what you might expect to pay this coming year. So that's one way to do it.
Should people be doing like installment payments, like monthly or quarterly?
Yeah. So there's estimated tax payments deadlines throughout the year. So there's April 15th, June 15th, September 15th, and January 15th of the following year. And basically that's supposed to cover the, first, second, and third quarter and fourth
And is
quarter.
there like a threshold for how much estimated taxes that you're supposed to pay that will determine if you're supposed to pay quarterly or not?
Yes. So basically, if you're going to have to owe more than $1,000 in tax, at the end of the year, which most business owners are going to be. If you're a business owner, the easy way to say this is, if you're a business owner, yes, you have to pay estimated taxes. Without, with almost without exception. There's a few. If you have another job that's taking, there might be a, you're paying, because you're paying estimated taxes kind of like through your W-2 when they do withholdings. So that could be a thing, but for the most part, if you're a business owner, you should be paying estimated taxes in most cases.
So if we have those estimated taxes, you pay your installments that are about the amount that you spent, you paid in the previous year. What are some tracking mechanisms or processes that people should be doing on a, weekly or monthly basis to track, potential tax, like, revenue and profit and gross margin and future tax liability?
Yeah. So the biggest thing is, you pay money for the most part on your net profit. Obviously the tax deductions are a little bit different than what you might see on your P&L, but it's a pretty good rough estimate of what you're going to have to pay, what your taxable income is. You look at your P&L as your net income on there, your bottom line. So that's what you're paying taxes on. Now, if you're running salary, obviously for yourself, like if you're an S corp, that is also going to be taxable at your income tax bracket as well. And
Like
then you have your
personal tax rate.
Right. Yes. So yeah, because you have different rates depending on how much money you're making. It's progressive tax rate. So it starts off at like 10 and then it goes up all the way to 37%. So depending on how much money you're making, you're paying that interest rate, and it's progressive. So you don't pay like 37% on all your taxable income. It's the first $10,000 or whatever is at 10%, and then it goes up from there.
I know you're just talking federal, like there's state taxes on top of this.
Yeah, exactly. Yeah. So yeah, if you're in California, I feel sorry for you, but yeah, you got your state income taxes as well. If you're in Florida or Texas, you don't have to worry about that. So basically, you're paying for the income tax. You're paying taxes on your net profit plus any salary that's going to you, and then if you're married filing jointly, that would include your spouse's income as well. So you add all that up, and then you can look up any tax table. There's a lot of tax calculators if you just want to get a rough idea. You plug in your W-2 wages and your business income, and it will generate like how much taxes you're gonna need to pay. Or now you might have paid estimated taxes throughout the year, so you're supposed to be pay, the IRS is a pay as you go system, so you should be knocking off of some of that. Plus, you're paying taxes through your W-2 wages. In most cases, you're unless you have done something to jack up the allowances or something, you're probably paying federal and state income tax through your W-2 wages as well. So those two things, your estimated tax and your withholdings through your payroll, that's what you're paying throughout the year. And then what you owe is basically your net profit, your salary, your spouse's, same thing there. Add those up and apply it to your tax bracket.
Okay. So online tools, any specific online tool that you feel is really good?
Yeah, the IRS actually has one that is, I mean, go to the source there. If you go like IRS withholding calculator is what you're looking for, and it has a tax withholding estimator is what it's called.
Okay.
IRS tax withholding estimator, and it has all the things built into it. Even though it sounds like it wouldn't apply to business owners, it definitely does, because there's a portion to plug in like your business earnings and stuff like that. So
cool. We'll link that link. If you can get me that link, I'll just link it below the podcast in the description for people.
Sure. Absolutely.
So keep moving on, like down the path. So we figure out, last year's tax, we kind of have an estimate for this year's tax. We have the number. Oh shoot, we haven't done any sort of payment. So now we owe this much money. What are some of the preparations that people need to do, like from Jan 1 until, March 31st or whatever date the payments due? What are some things that they should be doing right now to get on top of this?
So if you haven't done any estimated tax payments, we just passed the last deadline, January 15th. So if you can do at least one estimated tax payment by that date, that would be better than none.
Are there interest due if you don't do them?
Yeah. Yes, for failure to pay tax, it's like 0.5% interest. So it's not terrible, but if you can avoid it, you definitely do that. But the biggest thing is you want to make sure you're filing your tax returns, right? So getting some records together for the year, so you can generate a tax return off of that. So if you have QuickBooks Online or something, making sure the books are squared away, reconciled, so that you can generate a tax return off of your books.
Yeah.
You also have your January 31st is for any subcontractor or any independent contractor filings for your 1099. So any folks that you paid as a sub, which basically, if they weren't on payroll and you just wrote them a check, you're basically paying them like a subcontractor.
Yeah.
So you would want to file a 1099 to the IRS and also send it to them.
For each sub.
For each sub, exactly. Which is basically just a form that says, hey, I paid you, $20,000 this year. And in order to file that, you'll need their name, their tax ID number, which is usually their social, or maybe it's their employer identification number, and their address. And so those three things you'll need to file. And hopefully you got a W-9 from them, which is what captures that information from them. So before you put someone on the job site, if they're a subcontractor, get that W-9 filled out by them, say, as a requirement. But if you're, listen to this now and you're like, oh crap, I didn't do that, have them, fill out a W-9.
And hopefully they have a TIN.
Yeah. So you can do your 1099 filings, which are due January 31st. And there are late penalties for filing late for the 1099. So it's definitely something to pay attention to.
Okay. And you file that just on the IRS portal?
So if you're using QuickBooks Online, they actually have a pretty good tool because you're hopefully doing bookkeeping in there and you're tracking what you're paying your subs in QuickBooks Online. They have a tool that's built right in there, and you can do the e-filings pretty easily through that. You can submit 1099 forms by hand, mail them into the IRS as well. There's also something called Track 1099, which you can do it online if you don't have QuickBooks Online or something like that. That works pretty well.
Yeah, if you don't have a bookkeeping software, what are you doing? You need a bookkeeping software. QuickBooks Online, definitely recommend. That's what I use. That's what you recommend as well.
Yes.
Yeah. Okay. So what's after January 31st once you get your 1099s all filed?
So then we are up against the March 15th.
Before we do that, before we move on to that, hold that question in your brain for a second. What if you have, because this is going to happen to a lot of people, what if one of your subs doesn't have a TIN or you can't get it from them?
So you can file basically what you have on them, and then you're going to have to do backup withholding, which means you'll have to, similar to an employee, when you withhold taxes and you pay the IRS, you'd have to do that with your sub. So so that the IRS wants to get paid. Now, it's really important to get that W-9 before you have folks work with you, because potentially you could be on the hook for paying their taxes if you don't have their address, their social, and their name. So really, prevention is the best cure. So making sure you're getting that W-9 before they start the work is the best way to handle it. Now, if you don't get it, you can do a filing that doesn't have all the information. Not ideal, because IRS is going to come back to you and say like, hey, they might keep you on the hook, and we've seen this happen before, where the business owner actually had to pay the subcontractor's taxes because he left the country. So yeah, ideally get that information from them so you can file those.
You said that's the W-9 form?
Yeah, W-9. Yeah, if you just search IRS W-9.
Yeah, I'll come up. All right.
Yep.
All right. Moving forward, March 15th.
So this is the business tax return deadline. So if you're in the camp of having LLC taxes and S corp, this is where you want to make sure that 1120S is filed. And if you can't make that deadline, you can extend it by 6 months. So you have a little bit more time to prep that. So that is now if you're a sole proprietor or a partnership, well, if you're a sole proprietor, you don't need to worry about this deadline. If you're a partnership, you do have to worry about this deadline. So it's either S corps or partnerships. March 15th is the deadline for getting your business tax returns submitted.
What are the steps that someone has to take in order to compile their tax return and file it?
So basically, for the business tax return, it's for partnerships and S corps, they are not taxable entities. The taxes flow through to the owners, and the owners pay the tax on it. So on your personal tax return, which is due on April 15th. So really, what this tax return is basically your revenue minus your deductible expenses to get a taxable income amount, and then you get a K1 document that basically has, here's your portion of all the earning, the net profit, portion of your interest, portion of all this separately stated items. So you can fill out your personal tax return. So the biggest thing is, having some sort of records of what happened in the previous year, and giving this to your tax preparer so that they can fill out the 1120S or the 1065 partnership return.
How important is it to keep every receipt from everything that we buy?
So there's a couple of deductions that are scrutinized a little bit more than the rest. So in the US, like meals are scrutinized. So basically, for a meal to be deductible, you'll need to be like a business meeting with a client, a business meeting with an employee or a subcontractor, where you're discussing business, right? So those are deductible. However, there's different percentages, and then you'll need to have documentation that a business discussion took place. So, for example, if you took out your employees to lunch to discuss business, and then whatever, you would want to keep the receipt, right on the receipt, business lunch with employees, and save that receipt digitally or physically.
And all you have to do is write on the back of the receipt what kind of the business purpose was, and
right. Yeah, that's the requirement. Is IRS wants to see a justification for taking a meal deduction.
Mm-hmm.
So this could be taking out a client, taking out a employee or sub, doing a holiday party. So any meals for the benefit of employees, like a holiday party, that's 100% deductible. 50% of deductible for like taking out an employee for business, or taking out a client for business. Any personal meals that you're just going in between jobs, that is not deductible. So to answer your question, like, do we need to keep receipts for meals? Yeah, and then have the justification written on there. The other big one is like travel or conferences and stuff like that. So Business travel, like the meals still apply there. It's a travel meal. You'd want to write that on the receipt. And, if you're going to the PCA or, the painter growth event, you would want to make sure you have those receipts saved, because that might be scrutinized a little bit more than if you went to Sherwin-Williams and,
If
bought
you
some
lost
paint.
like your Home Depot receipt, not as big of a deal.
Yeah, no, the IRS will take your bank statement that says Home Depot. They're not going to give you a hard time about that. But
Yeah.
meals, conferences, travel. The other big one is vehicle, especially for miles. So if you're tracking mileage on your vehicle and taking a deduction of, whatever the mileage rate is now, 60 something percent or 60.6% per mile. I'm sorry, 60 something cents per mile.
Yeah.
If you're doing the mileage and getting that as a deduction, you'll need to actually track your miles in a mileage log.
So most
this
people
could be
don't do that. I know most painters,
yeah,
and most painters don't do that.
yeah, it's a struggle. So that's another one that's really scrutinized. If you took miles, they'll ask for your mileage log when you're audited. And so the way to make this easier is there are apps like Mile IQ that has GPS on it. So you drive, and then after the end of the drive, you swipe left or right, but personal or business, and then it will log that, and it'll give you a mileage log at the end of the year, and it will even memorize your routes, so that if it's a typical business route, we'll categorize it as business. So that's like the most hands-off way to do it. You can also just literally get a log and require folks you or whoever you're working with to put the miles in the log, and when they're business and when they're not.
So the way that most people do it, and we'll see if there's a way to fit this in, is that they will have a vehicle purchased personally that they'll use in their business, and they will drive it 80% for business purposes, 20% for personal purposes, and probably write off and pay all the gas on their business card. Right. So that's I would say the typical case. Maybe the vehicle is owned by the business, maybe it's owned by the person, but they put the gas on the business card. How does that work for tracking?
So in most cases, in that scenario, the typical case, the most deduction you're going to get is by taking mileage, because there's two different ways you can get the deduction.
Okay, so taking mileage is going to get people the most money back, the most tax deduction. Okay.
Yeah, unless your vehicle was super expensive, like if you paid over $50,000 for your vehicle, which could, and also you didn't drive it that much.
New truck these days, like my buddy just paid 110 grand for a new Chevy. Like, it's crazy.
Yeah, so it's possible you could have a really expensive vehicle, and it's less straightforward. It might be better to take one or the other. So a calculation would need to be done to determine. But if you paid under 50,000, you're pretty safe to say, and you're just driving the vehicle every day for work, it's probably mileage is going to be the best bet. If it's over $50,000, then
how detailed does your mileage log have to be? Like 27 kilometers to Mrs. Jones' house, 7 kilometers to the paint store. Does it have to be like that?
Yeah. It's ridiculous. Didn't make the rules, but yeah, it's pretty detailed. You gotta, every trip you have to log, which, yeah.
You'd think there would be like a way where they could GPS it and it would be like an automatic upload to a ledger.
Yeah, they do have, like, Mile IQ is like and that's something they don't pay me to say this. There's other ones out there too that do this, but that basically GPS, and you can just swipe left or right kind of thing, and then it will even memorize, like if you're going to the paint store every day, like it knows that you're going to the paint store.
That's pretty cool.
Yeah.
So vehicles, obviously something that we need to keep track of. That's a highly scrutinized thing. We're now at March 15th submitting our corporate tax returns. What else do we need to do to make sure that everything is in tip-top shape and we're not going to have any surprises?
So it kind of goes back to what we were saying. Make sure you know what your entity is. Sometimes folks, they think they're one thing, but they're not.
How do you
So
find? How do you
worst
figure
case,
that out?
call the IRS and say, what am I? I want to make sure if you think you're an S corp, but you don't have any documentation, like you
Yeah.
should get a letter that says, hey, you are now going to be taxed as an S corp moving forward, or your LLC is going to be taxed as an S corp moving forward. If you're not sure, you can just call the IRS and ask them, and they'll send you, they'll tell you, and then they can also send you another letter. So making sure you know what your entity is, and then you're filing the appropriate return, because you would think that you thought you're an S corp, and you do an S corp tax return, that the IRS would be like, hey, why'd you send us? You're not an S corp. They won't tell you. So you gotta ask, and you gotta make sure you know. But yeah, so make sure you're the right entity. Make sure you know your entity. Make sure you have your books put together. For the previous year, so that you can hand that off to someone to do the tax return,
So when
the
you say
business tax
books
return.
put together, like what should that look like?
Yeah. So at a minimum, you have your basic categories. So you have like your revenue. So money accepted. Most folks listening to this will be a cash basis taxpayer, meaning any dollar in received from a customer for payment for services, that's going to be revenue. Like,
Versus
so that's
accrual, where like a larger commercial contractor, where they have a lot of contracts out and work in progress, like they'll work on an accrual base.
Right. They will definitely be accrual base for managerial accounting, meaning like internal tracking, but they might still be a cash basis for tax purposes, because unless you are a very large business or you elected to be accrual basis, you're going to be cash. Everyone by default is going to be cash starting out. So basically any dollars in, you're categorized as revenue. Then you'd want to have your basic accounts, paying for labor or subcontractors, direct labor. You're paid for materials, categorized, like all your Sherwin-Williams purchases or Dunn Edwards, whatever. It's all going to that account. And then down the list, you have like advertising, your insurance. Those things are just separated in those basic accounts. If you want to just do bookkeeping for like tax return, you can actually pull up an 1120S or 1065, and it'll give you like the categories that are listed there on the face of the return. So that just gives you some basic categories to go with. Now that if you have balance sheet items, or like vehicles or loans or credit cards, those are on the balance sheet. So ideally, especially if you're being taxed as an S corp, you're held to a higher standard. So you'll have to have a balance sheet that makes sense. So a balance sheet is basically a report from your bookkeeping software that shows you all the balances of all your different accounts. So your bank account, your credit cards, your Sherwin-Williams accounts, your loan for any business loans that you have. So that should show an accurate listing of all the balances, and that's required as part of your 1120S filing, showing that balance sheet.
Your balance sheet, yeah.
Yep. So making sure that's often, especially if folks are doing that on their own, that's kind of difficult to generate on your own. So if you're a sole proprietor or an LLC disregarded, taxed as a sole proprietor, or a partnership, you might be able to get away with not having a balance sheet and just having some really, really, just basic books. Once you're taxed as an S corp, you got to have professionalized.
If you're using QuickBooks Online, the balance sheet, and you link your bank accounts, the balance sheet's pretty much automatic.
I wish that was the case.
Okay, my bookkeeper is just really good then.
Yeah, you gotta. It does help for sure, connecting your bank accounts to QuickBooks Online. That can definitely help. It just gets, making sure you're reconciling the accounts each month, and especially with loans, splitting out principal and interest. It can get a little bit, probably you have somebody that knows what they're doing to handle it. Because especially if you're an S corp and you're not familiar with how to do bookkeeping, just get somebody to handle it for you. Once you're especially taxed as an S corp. So March 15th, S corp due, partnership tax return due, and then the next one is April 15th, which is the personal tax return. So there is an extension to file which is an extension to file but not to pay. So that's something that folks get hung up on. You can extend your, on April 15th, you can get a 6-month extension to file the tax return, but you'll still need to pay the tax owed on that date.
Or else
So
interest will start accruing at that 0.5%.
yeah, interest and penalties. Yeah.
Yeah, 0.5% per month or per week or per what?
I think it's per month, but it's just not per week. I think it's per month. But then there's also the failure to pay as well. You get penalties on top of that. And then just quick about the business tax returns, definitely make sure you file on time or get an extension in, because there's a very severe failure to file for those. Personal tax return, you can do extension, but you'll need to pay the tax owed by April 15th. Or you get hit with some penalties there. Yeah, and so that's the first part of the year as far as the dates go.
Tax for dummies, easy as that. So is it too late for someone to like get help for 2023 or what? Like if this is very overwhelming for a lot of people, they're like, hey man, I'm just painting, I'm just running crews right now. I don't want to deal with this. Is it too late, or can they still get a bookkeeper for 2023?
Yeah, you can get somebody to put your records together and do like the late election for S Corp if you need that. It's most of the time it's accepted by the IRS. You can have them. If we're getting down to the wire here for the 1099s, there's no extension for that, but at least you can get those filed as early as possible. If you're listening to this and it's after January 31st, to limit the penalties that are associated with that. But yeah, to answer your question, yes, you can definitely get help for 2023 and get that squared away.
And so how do you guys help with this whole year-end process for painters? Like if someone came on and reached out to you, say, hey, Daniel, help me out, I'm stuck. How would you take a painting contractor and help them get figured out by March 15th?
Basically, a lot of the things we just talked about, like what entity, how are you set up? Does it make sense to be set up like that? Should we do maybe go back and get you taxed as an S Corp or just leave it as is? And then from there, okay, do you have books? If not, we can put those together. And then make sure that we get your books together, file it, or do an extension if we need more time because we're, you're late on getting everything together. Basically everything we just talked about, we can help you out with and get you squared away.
You'll do the filing for the IRS, setting up the QuickBooks, doing all the categorizations and making sure you don't miss any dates and stuff like that.
Yes.
Sweet. What's the easiest way for someone to reach out and just have a chat with you or one of your team?
Yeah, if you go to bookkeepingforpainters.com, there's a link at the top right to schedule a call. We'll jump on a call, see what you're facing, and put a plan together to get you squared away.
I mean, that's pretty easy, right? Than trying to figure it out. And I mean, what's the value? How much money do you think you could save, like the average contractor who say took home, 80 grand? What are some of the potential savings that you could see if like you just took it off their plate instead of them doing it themselves?
So yeah, if they're netting 80 grand or
netting 80 grand.
Okay. Yeah. So we talked about the S Corp election. Like in that case, they would probably be saving, at least $5,000 in taxes right off the bat there, just by getting them in the right entity status, and then making sure that they're getting all the deductions that they should on their tax return. So and ideally they would sign up for the tax planning program we have, which on average we were saving $29,000 per tax planning client that we have, because we're doing this throughout the year instead of like, oh crap, we need to do this all right now. The tax planning program, actually, there's more advanced tax planning strategies you can do outside of we just covered the basics today. This is just compliance and basics, but there's things you can do that are, hire your kids, start a retirement plan, put together a holistic plan that's tax efficient, to save you a lot, tens of thousands of dollars in tax, and do that proactively throughout the year. So yeah, we've saved, I know, like individual tax planning clients, we've saved them hundreds of a few of them hundreds of thousands of dollars in tax because of the situation they're in.
Wow.
But yeah.
That's awesome. So clearly, if your taxes are a mess and you're not sure where to start, and you're like me, it's like, I don't want to even look at my books. I like to look at my completed books, but I don't like to get in the weeds. You need someone like Daniel in your corner, 100%. Sweet. Thanks for coming on, man. I think that was valuable. I hope that people got value out of that. Any last remarks?
No, I think just make sure if you're just getting started, get the basic compliance things out the way. Filing your tax return and getting basic set of books. There's a lot of resources out there. We have the Profitable Painter podcast. We cover a lot of this stuff for especially, if you're just getting started and you're not quite sure about tax or finance. We cover a lot of these topics. Yeah, go from there.
Awesome. Well, thanks for coming on, man. I think that's super helpful for anyone trying to get going for their tax year. And until next time. Thanks for listening to the Painter Growth Podcast. If you want to grow your painting business, go to www.paintergrowth.com or click on the top link in the description. Talk soon.